Good morning, everybody. Today's Thursday, March 26th, and it looks like the third correction of this bull market could now be in effect. Now, I've been telling you for years that corrections are a normal part of the stock market cycle. Generally, we expect a correction every 12 to 18 months. And this bull market that began almost 3.5 years ago has delivered exactly that. We've experienced a correction about once every 12 to 18 months. Okay. So what I want to go through with you today is a review of the corrections that we've had so far, a discussion about the difference between a correction and a bear market, but then the real concern with every correction, and again with this correction, is that corrections can lead to a bear market and can lead to a recession. All right, let me go ahead and show you something that I think you'll appreciate here. All right, so what you can see is this is the S&P 500 over this 3.5 year bull market so far. And just a reminder, this bull market began in October of 2022, following the 2022 bear market. That 2022 bear market was caused by the Federal Reserve increasing interest rates farther and faster than they ever had in history in order to combat high inflation that caused the 2022 bear market. And since then, we've had a 3.5 year nice bull market run, but not an uninterrupted bull market run. 12 months into that bull market, we had our first correction in the summer of 2023. We saw the stock market drop by about 12%. That correction was not so much because of recession fears, but sort of a rejiggering of growth expectations. Because 12 years into that bull market, the Federal Reserve had signaled that they were more likely going to keep rates higher and longer than was previously expected. High rates generally equate to slower growth expectations, so the stock market had to adjust accordingly. And we saw over a couple month period the stock market drop about 12%. But within a 4 month period of time, we had already reached a new all-time high in the S&P 500 and the bull market continued for about another 18 months until the second correction of this bull market happened. That happened in response to President Trump's Liberation Day announcement that he was going to increase tariffs globally across the entire world. Okay. Tariffs, like high interest rates, are generally a drag on growth. All right. They're an extra tax that we all pay on goods imported here into the US. And so that would equate to a decrease in overall economic activity. The stock market responded by a drop of about 16% in the S&P 500. But then pretty quickly the stock market rebounded back when it was looking like possibly these tariffs weren't going to be as bad as they were for as long as they were. And again, it took about 4 months for the stock market to reach a new all-time high. So first correction happened 12 months in, took about 4 months to reach a new all-time high. Second correction happened another 18 months later, took about 4 months for the stock market to reach a new all-time high. Now, here we are about 12 months from the last correction, experiencing what is possibly going to be the third correction of this bull market. Now, we've already seen stocks drop about 7% since the Iran war began. We were starting off the year very, very strong. Stocks in your portfolio were up strongly in January and February, but then March happened. Okay. And this might just be the month that you don't want to open your statement because it is going to be a little bit painful. But it's important to remember that even though, yes, your portfolio is down in the month of March, yes, this could be another correction. The most likely outcome is that this correction is again, like the last two, going to be a temporary correction. Now, here's the caveat. Like all corrections, there's always the concern that a correction can lead to a bear market recession. And the odds that this correction does lead to a bear market recession is much higher than the previous corrections. When the Liberation Day tariffs hit, I would have put the odds of a recession at about 15%. Pretty low. Today, both myself and other market market evaluations are putting the odds of a recession at somewhere north of 40%, maybe 45% chance of a recession. Okay. So there is still a strong possibility that this correction could lead to a bear market recession, but it's still not the most likely outcome. That was a big reason for our push several weeks ago to move to protect some of our retiree client portfolios with a structured note or a buffered ETF to again kind of close the gap between the possible outcomes of the portfolio. The highs wouldn't be as high and the lows wouldn't be as low. Now, for our clients who are still in the growth phase of life, you're still working, you're still more than 10 years away from retirement, okay? We're not recommending closing that gap. We're not recommending shifting out of equities. These are things that you are prepared to ride out, okay? Because you've got the time to recover from whether it's a correction or a bear market recession. You've got the time to ride it out. So hang tough. This is a relatively normal cyclical thing that we go through in every bull market. I know that given all of the uncertainty right now and the stress, this probably feels a lot different. But economically, this isn't that different. It's a whole lot of the same all over again. Okay. Now, there are always things we're worried about. There are big things we're worried about. There are disaster scenarios. And I promise you, we're keeping a very close eye on all of those. And we would not be shy about protecting your portfolios from those disaster scenarios. But that's not the most likely outcome this time around. If you have questions or concerns, please reach out. Myself and my team are available to talk through your individual situations and help you feel comfortable with your portfolio and the long term growth that will help you accomplish your goals. See you guys later from Jon Courtney at Village Wealth Advisors. Remember, if you have a friend, family member, a colleague who you think would benefit from this information, please forward this video along. And just remember to think of us that when you're ready to retire, we're the ones to hire. Take care.